It's funny because we're doing three topics that make all accounting majors cringe. The first one, leases, the second one, pensions, and the third one is income tax reporting. These are three very complex areas. The fourth one, which isn't here, is financial instruments, hedge accounting. Is the fourth one, which we do in advanced accounting. And these areas really freak out accounting majors. And the minute you bring them you bring them up, they really get scared and they run away. If you're an accounting major, you're probably having trouble watching these, and if you're not an accounting major, then you're probably looking at it and you're saying to yourself, "What in the world is he talking about?" Well, I'm trying to, for the non-accounting majors here, I'm trying to get around the calculations and towards what's really important, and that's understanding what these things mean. And one of the things that I find for even accounting students is accounting students often learn the mechanics of how to do this so they can answer some multiple choice questions and maybe do a few journal entries on a test, but they still don't really understand what's going on. And I find for a lot of students, for example, with pensions, unfunded, the funded status or unfunded, they don't realize how important that is. That if a company has an unfunded pension, it has to pay it. And oftentimes that full unfunded pension doesn't appear on the balance sheet. So we got to understand what all these things mean and understand them on a deeper level, and because we want to be able to understand them when we see them in financial statements. And that's so important to being able to read financial statements and understand what's really going on. You know, financial statements don't tell the whole story, or they do tell the whole story, but they do it in a very confusing way. And sometimes you have to read between the lines. You have to read the notes very carefully in order to get at the information that you really need. And income tax reporting is one of those areas. Now, what makes income tax reporting especially complicated as I shoot this video is the Tax Reform Act of 2017. And this was passed in December 2017, and it involved primarily a very significant change in tax rates. It also involved a change in how foreign taxes are taxed by the United States. And so the book is not up to date on the new Tax Act, unfortunately. It was just published, but they had no idea this Tax Act is coming out. I'm going to bring in some insights about the new Tax Act too as I record this video. But you want to keep in mind, these rules are all the same, but especially in 2017 financial statements and often in 2018 financial statements, the new Tax Act is going to have very strange effects on the financial statements. So the key to understanding this is that we have two systems for calculating income. One system is called GAAP, Generally Accepted Accounting Principles, and that's what we teach in all our classes. And the other system is called the IRC, the Internal Revenue Code, which is used to calculate your taxes. So just because you have GAAP income doesn't necessarily mean that it's taxable income. And just because you have taxable income doesn't necessarily mean that that taxable income is GAAP income. And in fact, your income tax expense is not necessarily the amount of money the company has to pay to the IRS. So there's two different sets of accounting rules here, and they recognize revenues and expenses differently. So we've talked about revenue recognition, and we've talked about expense recognition according to GAAP. But oftentimes, IRC, Internal Revenue Code, is different from GAAP. And therefore, the amount of money we have to pay the government doesn't necessarily match the amount of income to compute our taxes is usually not the same as the amount of GAAP income that we report. And what companies want to do, of course, is they don't want to pay less taxes. Oftentimes, companies can engage in transactions to save taxes. What happens more often, though, is that these transactions don't save taxes, but they simply defer taxes. They put off those taxes to a future period. We know from time value of money that the later you pay for something, the earlier you receive something, the better, and the later that you pay for something, the better, right? So what companies naturally want to do with their taxes is they want to receive tax benefits and deductions sooner, and they want to record taxable income later. And this will allow them to pay their taxes later, to do what's called tax deferrals. And this is perfectly fine. The IRS doesn't expect you to compute your taxes based on GAAP. They expect you to compute your taxes based on their own internal revenue code. And therefore, this is going to create differences. So these differences generate what we call deferred tax assets and deferred tax liabilities. The classic example of this is depreciation. In financial accounting, we like straight line depreciation because it's simple. You record the same amount of depreciation every year. But the IRS allows you to do something different. They allow you to use something called MACRS, Modified Accelerated Cost Recovery System, or accelerated depreciation. That means taking more depreciation when the asset is new and less when it's later. So that gives you a bigger deduction early on when the asset is new and less of a deduction later on than if you were using straight line. Because companies want that. They want deductions sooner. So accelerated depreciation really delivers on that count. It allows them to take more depreciation on their taxes now and therefore pay less taxes. Later on, they're going to have less depreciation, so they're going to have to pay more taxes. And again, companies could use accelerated depreciation on their taxes, but use straight line depreciation still on their financial statements. And that really gives them the best of both worlds, because on their taxes, they have big deductions now, smaller deductions later, which will give them less income. And on their financial statements, they'll have an even amount of depreciation, which will give them a nice even amount of income, or I would say more income than the IRS would allow, and make them look better for their investors. So this provides a benefit, and it allows companies to pay by taking more deductions now, less deductions later on. Companies are in essence deferring their taxes. They're putting off their taxes until the asset becomes older. And this creates something called a tax deferral. Here you can see the difference. Let's say with Southwest Airlines again. Accelerated depreciation is more depreciation now, less depreciation later. So for tax purposes, you're going to have less income now, more income later. Whereas straight line for GAAP is going to give you an even amount of income, or you could say more income. It's going to give you more income now, less income later. Did I say it the wrong way? Sorry, accelerated depreciation is going to give you less income now, more income later, which we want for taxes because we want to report as little income as possible. For GAAP, straight line is going to report more income now for our investors and less income later. So this little area in the middle here, this represents a gap, which creates a tax deferral. And it generates what we would call a deferred tax liability. So let's look at a company and look side by side at their financial reporting and their tax reporting. In financial reporting, you'd have income before depreciation at 200 minus your depreciation of 50 will give you income before taxes of 150. Let's say tax rate is 40%, so $60 worth of taxes, and then net income of 90. But on your IRS statement, your tax return, you have 200 income also, but you have 75 in depreciation because you're using accelerated depreciation. So your income is lower, your income tax is lower, which is what you want, and your net income is lower. But the thing is that you're not really saving taxes here. You're just putting it off until later on. And so what you're going to need to do is you pay $50, you have a full tax expense of $60 here. You're going to report the full tax expense. $50 gets paid now, and $10 gets paid later. Is deferred tax liability. Let me repeat it again, because this is really key to understanding the whole thing. Under GAAP, you have $60 in tax expense. Under IRC, you have $50 in tax expense because you're using an accelerated depreciation deduction. So what you're going to do is you're going to record a $60 tax expense now. You're going to record cash for $50 because that's what the IRS wants now. And you're going to create a deferred tax liability of $10. That will be wiped out later on when this all reverses itself. So this is a real liability because eventually you're going to have to pay that extra $10 in taxes when this effect here reverses. So going to year 2, again we have the same scenario, because in year 2 our accelerated depreciation still exceeds straight line. So in year 2, under GAAP, I have 200 in income, 50 in depreciation, 150 before tax, 60 in income tax expense, and 90 in net income, just like last year because it's straight line. In GAAP, I have 200 in income, but only 25 depreciation, so my income before taxes is 175, and therefore the income tax that I have to pay is 70. I guess this is reversing in year 2. I'm sorry, I got this a little wrong. This is reversing in year 2. So my net income is going to be higher and I have to pay the extra taxes. So what I'm going to do here is I'll record income tax expense of 60, right here, shown here. But I pay 70, and the difference of 10 comes out of the deferred tax liability because I deferred it in year 1. Now I'm going to pay it in year 2. Deferred tax assets go in the opposite direction, and this would be a situation where the tax payment exceeds the tax expense. That would create a deferred tax asset where you would be entitled to tax savings later on. In other words, there's some kind of future tax deduction that you can take in the future. This generates what's called a deferred tax asset. Let me give you an example of a deferred tax asset. Restructurings. We've talked about restructurings before. This would be a situation where a company decides to restructure its operations, basically to lay off employees. And we said the accounting is that you got to figure out the total cost of the whole restructuring and record the expense now. And you know what the IRS says? The IRS says don't do that. The IRS says we don't want you arbitrarily coming up with some huge loss and deducting it on your taxes. Rather, you can deduct it when you pay it. So when you finally pay those employees all their severance pay, which might be 2 or 3 years from now, then will allow you to deduct this on your taxes. But you can't just come up with some huge number, report it on your income statements, and deduct it on your taxes. So the way restructuring works is you record a big expense right now and on your GAAP financial statements, but for tax purposes, and then that entitles you to the deduction later on when you actually pay this expense to your employees or whoever else you're restructuring. So this becomes a deferred tax asset because in essence you have a deduction in your pocket which you can take advantage of later on. A tax loss carry forward in deferred tax assets. Now, the deal with a tax loss carry forward is this. When you make money, the government takes a piece. The government is your partner. When tax rates with federal government tax rates with 35% or so, then 35% of your income belongs to the federal government, and a portion of it belongs to the state governments too. Well, this works the other way too. It's only fair. If you lose money, then 35% of the loss belongs to the IRS, and they should give you the money back. Now, tax rates are different. They're 21% now. It still works the same way. So when you have income, the government gets 21% of that. If you lose income, you have a net loss, then you're entitled to 21% back from the government. Now, I know this sounds weird. It doesn't make any sense. Why would the government pay money into companies that are losing money? But when you think about it, it's really fair. If you're going to share in the income, then you have to share in the losses. And this is called tax loss carry forward. So the way the IRS works is, if you lose money, you're not just going to get money for free from the government. What you can do is you can get money back to cover their percentage of the loss, either from what's called a carry back. That would be 2 years in the past. In other words, if you paid taxes in the 2 years in the past, you're entitled to recoup some of those taxes to cover your loss. And you can get that money fairly quickly. Or what you can do is you can hold on to those losses, and then when you have profits in the future, you can take them back against your future income. So next year when you're profitable again, you can say, hey, but we lost money last year, so we have this get out of free card, And we're entitled to save so and so many dollars on our taxes. So any new losses that you have can be offset income and reduce your taxes. So if you hold on to these tax loss carry forwards, carry back would be when you go back to the previous 2 years and you get refunds of the taxes that you paid. But you can also carry them forward into the future. If you hold on to the losses and then next year when you have profit, offset the profit with this year's losses, then you can reduce your taxes. So that's a form of a tax credit, and it's an asset. Now, the only way that you can record this asset is if you're going to have income in the future. So you have to show, in order to record this as an asset on your balance sheet, you have to actually show that you reasonably expect to have income in the future. So if you're a company like Tesla, right? Tesla's never going to make money. So it's in the news today. Tesla is begging its suppliers to lower their prices so they can become profitable. That's a sign of a company that's never going to make any money. So if Tesla has deferred tax assets, which I'm sure they do, because they don't have any profits to carry back against, then they can create a deferred tax asset for the future, except that they're not going to have any profits in the future either, so they wouldn't be allowed to do that. They can still, if they do have profits one day, they can offset it against the losses, but GAAP would not allow them to record that as a deferred tax asset because, come on, who's kidding who? They're not allowed, they're never going to have the profits. Actually, I kind of wonder. So here you can see Tesla's 10K. And I'm sorry for the 2016 one, but you could look at the 2017. And they had total deferred tax assets of 1.7 billion. But they had to record a valuation allowance against them of $1 billion, leaving only 731. And that's offset by deferred tax liabilities, leaving a net deferred tax asset of only $25 million, which is almost nothing. So you can see here from Tesla that the expectation is they're not likely to have future income to offset. They probably have it in some of their divisions and some of their subsidiaries so they can record something, but there's really almost nothing there, and therefore they can't record it. They still have, by the way, the deferred tax, they still have the carry forward. So if they do have income one day, they won't have to pay any taxes. And they may not have, they've lost so much money that they may never have to pay tax. They may not have to pay taxes in any of our lifetime, assuming the company stays in business that long. So anyway, if they don't expect to, if they're not sure if they can realize that deferred tax asset from a loss carry forward, they have to establish what's called a valuation allowance. And here you can see Tesla's, if you can see that small, net of the valuation allowance for 2016 was $1.022 billion. And that would reduce your asset, increase your tax expense, and so on. And now two things can happen. One is the company writes off a deferred tax asset, in which case, by recording a valuation allowance, or once it loses the ability to take it, they have to fully write it off. Or if it's realized, then they can only book it when it's actually realized, or they can book it on new income. So it's not symmetrical. In other words, you can take it off, but the valuation allowance on previous income that was written down can't necessarily be written up. But if you do have in a situation where you didn't think you would have income, and then you did have income, then you could have something called a reversal of valuation allowance. Here you can see a company that did that, American Airlines. And the reason why I'm going into this, it seems very obscure, but in fact, it's actually very important. So here you can see American Airlines had income of $4,668,000. American Airlines, if you're not familiar with it, had lost a huge amount of money. So much so that they weren't sure if it was ever going to be profitable enough to cover their losses, and therefore they had to write down their deferred tax allowances with valuation allowances. Well, lo and behold, the company got profitable, and here you can see. So when they got profitable, they decided to take advantage of their operating loss carry forwards. And therefore, they had a huge tax benefit in 2015. And look at the effect of this, right? They had $4,668 million in income, and then they didn't have to pay taxes on all this additional income. So they were able to reverse more of their allowances, take them back into income, giving them an income tax benefit of $3,452,000 and net income of $8,120,000. In other words, almost half their income came from a reversal of a deferred tax asset valuation allowance. And it sounds really technical, but when you see something like this, you can see the effect of what's going on. So it's very important to understand these things because they can have a profound effect on income. And now, let's go through Southwest disclosure for 2015, and then I'll talk a little bit about what's going on with companies today. You can see Southwest's footnote, and you can see how they calculate their provision for income taxes. What they're going to do is current means the amount of actual income taxes they have to pay, and then deferred are going to be income taxes that have been put off to the future. So you can see in 2014 they deferred a lot of taxes, but in 2015 it kind of reversed. So the deferred taxes actually reduced their income tax expense. And again, current, here it tells you down here, current tax expense comes from whatever they have to pay this year, $1.4 billion. But they had a reversal of deferred taxes. So basically what they're doing is they're slowly paying off the deferred, and therefore their income tax expense is going to be lower. Companies have to explain the components of deferred tax liabilities and assets. In other words, what is it that gave rise to the deferred tax liabilities and assets? Here you can see accumulated depreciation is giving rise to their deferred tax liabilities, as you would expect that it would, as I explained at the beginning of the class. Capital and operating leases are creating deferred tax assets. Construction obligations is a major one. Accrued employee benefits. Now hold on, I just want to give you a piece of advice here. Whenever you see anything like this, what you want to do is you want to look at the really big numbers, because that oftentimes will give you the most insight into what's going on. So here you can see, if you look at this column of deferred tax asset numbers, the way to look at it is to focus on which numbers are the greatest. So you can see here the largest figures, there's two of them. This $2 million, most of it consists of just two items: fuel derivative instruments and accrued employee benefits. Accrued employee benefits would be pension benefits. So that would be situations where they contributed to the plan, they have pension expense now, but they're not going to get the income tax deduction for it until later on. That's probably what it is. You can see here how these individual items come together to create deferred tax assets. Southwest is a company where continued profitability is fairly well assured, and therefore there doesn't need to be a valuation allowance. They also need to do something called a tax rate reconciliation, and you've probably seen this on your own company's report. What they would do is you take federal income tax rate, and you'd include other changes to the tax rate that may represent savings or increased taxes. So you have non-U.S. income tax at different rates, settlements, domestic money, and so on. R&D credits may reduce their overall tax rate. Another example of this would be Intel. So Intel had a big tax dispute where it had recorded more taxes than it needed to. So because they settled that dispute and it turns out they had to pay less, that reduced their tax liability. And it says here tax liability, it's really effective tax rate, by 2.9%. So you would want to look at these things and you would want to see what's permanent and what's likely to be temporary. So an increase in deferred tax liabilities indicates, again, just to summarize, that GAAP income relative to taxable income is higher. In other words, you have more GAAP income, less taxable income. The valuation allowance would be a situation where you have a deferred tax asset, you expect to have deductions in the future, but you might not have income. You don't know if there's going to be income to take advantage of those deductions, and therefore you have to record this valuation allowance. And the reconciliation may indicate important items that you need to be aware of. Here's a little bit about the new Tax Act, which is pretty cool. The new Tax Act reduces the general federal tax rate to 21%. And I'm not a tax person, so I know financial reporting, I don't know the Tax Act that well, but I can explain how it impacts financial reporting. And so what this does is it's going to decrease the effective tax rate for almost all companies. When you're projecting your company's NOPAT, when you're figuring out NOPAT and projecting income forward, you're going to want to use an effective tax rate of 21% for federal, and then whatever the state rate is won't change. So if you see that a company also pays significant state or local taxes, New York City corporations pay local income tax, then you need to add that to the federal taxes. Also, foreign income tax is not going to change. So this is going to have a huge effect on companies' deferred taxes. Previously, deferred tax liabilities were valued at whatever the effective tax rate was. So if that tax rate goes down to 21%, then the value of any deferred tax liability is also going to go down. This is good news. So if you were using accelerated depreciation, taking these big expenses, you can laugh and cheer and you can throw parties, because now that it comes time to pay them, you only have to pay them at 21% instead of paying them at a higher 35 or even 38%. So that's good news. On the other hand, if you had tax loss carry forwards, which gave you deferred tax assets, previously you could offset them against a 35% tax rate. Now you can only offset them against a 21% tax rate, meaning you would have to pay less taxes anyway. Therefore, you're going to save less taxes because the tax rate is lower. And therefore, the value of the deferred tax asset is also going to go down proportionally with the tax rate. Now, if you had an allowance against your deferred tax asset, that allowance will also go down in line with the deferred tax asset itself. If you have an allowance, the asset goes down, the allowance offsetting it is also going to have to come down. The other thing that's very significant here, so this is going to have a tremendous effect on all of your deferred tax liabilities and assets, and the differences, the changes in them, is all going to go to income. So if you had a provision for income tax, the write-down of deferred tax liability, you debit the liability, you credit provision for income tax, that's going to reduce your income tax expense. Likewise, a write-down of a deferred tax asset is going to increase your deferred tax. Is going to increase your income tax expense. There's one more thing here that's very significant to know about, and that is foreign income. Previously, foreign income, when it's brought back to the United States, was fully taxable. So it would be taxable at the full rate, even if you paid tax on it in the foreign country. And the new rule says that if you bring your foreign income back to the United States, if you bring it in the form of cash or liquid assets, it's taxable at 15.5%. If you bring it back to the United States as illiquid assets, such as physical assets, it's only going to be 8%, because they want to encourage companies to bring physical assets back to the United States. This is a huge boon. Now, previously, companies were assuming that they would never bring this income back to the United States. It would just sit in the foreign countries where they are. So these were what's called permanent differences, and therefore there was no tax liability for them. Once companies made a decision, which would have been probably December 2017, to bring these assets back to the United States, then they need to record a new deferred tax liability for these items. So if the company plans to bring cash assets back in, they would need to compute how much they plan to bring in and book a liability for that after they made the decision at 15.5% and illiquid assets for 8%. It appears that the law, there's some question about how this is going to work going forward, but the understanding right now is that whenever companies repatriate income, if it's in the form of cash, it'll be at 15.5%. If it's the form of illiquid assets, it's only going to be 8%. So this would result in, when the company makes a decision to repatriate, they're going to need to record deferred tax liabilities for this, and this would increase your provision for income taxes.